Good morning. Institutional investors around the world, but especially US-based corporate and public pension plans, are struggling. They're struggling because they cannot find ways to generate the kind of returns that were assumed many years ago when the plans were set up. These struggling institutional investors are searching for an answer, and one answer seems to be the private equity industry. I recently read an article in the Wall Street Journal which mentioned CalPERS, the large pension plan in California, and its attempt to double down on private equity in the hopes of saving itself from insolvency. And right now, I think is one of the worst possible times to be investing in private equity. And I really want to highlight to you why, and why I think investors who rush to private equity today are likely to be badly hurt over the next decade. Specifically, I want to highlight to you some of the research done by Daniel Rasmussen from Verdad Capital Management in Boston, Massachusetts. Daniel has written a fantastic article which was published last year in the American Affairs Journal, and I include a link in the description of this video to the article itself. In general, private equity managers have now convinced institutional investors that they will forever outperform public markets. And there is such a rush towards private equity today that over $200 billion of new investors' money is being committed to private equity every single year. And I believe there's almost no chance that private equity will outperform the public equity markets over the next decade. And I want to highlight three key reasons. Because institutional investors have become so enamored with public equities and private equities that they are now effectively willing to pay a premium for an illiquid investment, which is completely nonsensical. And it's a big change from where things were 10 years ago. The private equity pitch relies on three main points, all of which I think deserve a lot more scrutiny than they get. The first is the issue of performance. Private equity managers have convinced institutional investors that they're going to outperform forever and by a significant margin. And the reality is that according to Preqin data, private equity has already underperformed the public markets for the last 3, 1, and 5 years. And so when you ask, why has private equity outperformed in the past, and is it likely to outperform in the future, you have to understand what drives private equity returns. And I really reserve my comments for the leveraged buyout variety of private equity. I know there are many other types, but today I'm specifically talking about the leveraged buyout industry. The number one factor that drives LBO returns is the purchase multiple that an investment is executed at. In the 80s and in the 90s, most LBOs were being done at between 6 to 8 times EBITDA. And those deals really did generate returns in the high double digits. Today, the average purchase multiple is dramatically higher. And so there's almost no chance that private equity LBOs will outperform the public markets. Now, of course, there are different private equity firms out there, and there are those that are doing cheaper deals. They have incredible pricing discipline. But as a whole, there's almost no chance that private equity will outperform the public markets. Secondly, people have become convinced that private equity is actually less risky than the public markets. And this is complete baloney, because the reality is that private equity funds are valuing their portfolio companies using phony metrics and fake accounting. These are simple accounting tricks that allow them to value these companies using predefined formulas that reduce and take out the volatility from the portfolio, fooling investors into thinking that they have non-risky, non-volatile investments. Because many of these funds have a life cycle of 10 plus years, it's going to take a very long time for investors to realize what the true extent of their losses is in the future. The reality is that most LBOs are highly indebted companies. And highly indebted companies tend to be more volatile and more risky than the average public stock. But it's the usage of fake accounting and this phony measurement that hides the true nature of risk from the investors. And third, the third point that private equity managers make is that they dramatically improve the operating performance of the businesses that they acquire. And again, there are certainly some private equity managers out there that are experts at operating businesses, they have excellent operating teams, and are able to improve the performance of the businesses they purchase. But overall, the research is clear. When a private equity firm acquires a business, two things happen. Long-term investments go down, SG&A as a percentage of sales goes down, and debt and interest payments go up. At the end of the day, you shouldn't be surprised by this. There is no improvement in margins for the average private equity deal. This is ultimately the leveraged buyout industry. It's not the operating geniuses industry, let's be clear. And so what happens is there's no improvement in the long-term performance of these businesses. In fact, there's a high degree of skepticism that the long-term returns may be being impaired by reducing the investments that are being made today. So all those three criteria, all those 3 points that private equity managers make about why they will forever outperform, the performance, the risk, and the improvements in operating results of the underlying companies, are really false and they don't stand up to scrutiny. Now, private equity has over $1 trillion invested and ready to be invested in deals in the United States. And this has driven frenzied bidding for new companies to record levels. CalPERS has a wonderful data set available on its website where they showcase all the returns in terms of IRRs and cash-on-cash returns for all of their private equity deals and the funds they invested in. And the wonderful feature is that you can screen the data and narrow down, filter it by year, by the vintage year of when the fund was launched. The 2007 funds were particularly poor performers. They returned somewhere between 1 to 2% annualized returns. Now, in 2007, the average LBO was being done at 8.9 times EBITDA. Today, the average LBO in the last quarter of 2018 was done at over 11 times EBITDA. So wait till you see how badly these deals perform for investors over the next 10 years. There's no chance that CalPERS or any other institutional investor is going to save the returns for themselves, save the solvency of their plan by doubling down on LBOs and private equity at this point in the cycle. And I think if you're a government employee, you're a public pensioner, this should be an outrage because there's a good chance that a big chunk of your pension is allocated to private equity deals being done currently at excessive valuations. And with the 10 years life cycle of these funds and the fake accounting they employ, the private equity managers who manage these funds will have collected fees for over a decade in many cases before the true extent of the losses becomes realized. So with that, thank you for listening, and I hope we get a chance to connect and chat a little bit more about why you should be focusing on the transparent and rigorous and open public equity markets as opposed to the opaque, non-transparent private deals. Thank you, and I look forward to hearing from you.